Financial capital. Industrial capital is just a starting point, and it should obtain higher investment returns if it bears huge leverage financing risks. On the other hand, industrial capital believes that financial capital is just a booster for its development, and it is not cost-effective to work for others when busy. In this situation, industrial capital and financial capital inevitably compete with each other, constraining each other's development space. As for China, due to the imperfect financial market, the newly established financial capital actually does not have the strength to truly compete with industrial capital. Taking the circulation of restricted shares in the current capital market as an example, the industrial capital represented by untraded shares, non-representatives, is undoubtedly more advantageous than the financial capital. The lower holding cost and the absolute controlling position make the large shareholders extremely willing to cash out, forming an arbitrage space from industrial capital to financial capital. From this perspective, it is also doomed that the PE market has not been fully developed. That is the expression of bull to bear. Therefore, whether from the perspective of economic structure, institutional environmental conditions, or from the perspective of micro-attitudes and understanding, the main wave of PE investment has not actually arrived. Firstly, only when financial capital obtains a relatively symmetrical position in the game with industrial capital can the function of financial capital in improving financing and integration efficiency be greatly exerted, and PE has space to usher in a true spring. However, it is not difficult to see from the recent issuance and listing of China Construction Corporation that the role of financial capital in serving industrial capital is still difficult to change. See reference information for details. In addition, capital attributes determine investment philosophy. When long-term funds such as social security funds and insurance funds can join, Chinese PE investors and managers will become more rational and play an increasingly important role. Correspondingly, industry returns will return to normal levels. Blackstone Group's average annual asset growth rate in the past few years has been around 40%. From this perspective, at a time when PE has not yet fully developed and is turning from bull to bear, the investment of enterprises is highly likely to present the following three aspects. General trend. Firstly, if the future situation is the instinctive reaction is to lie down on the spot and rather freeze the money. These companies may. There is already upward momentum in adjustments, but the qualitative change in food under the impact of civilization has accelerated its recurrence of the oil price mistake. On the one hand, biofuels endow food with energy attributes, exacerbating the contradiction between grain and oil substitution and the competition between people and vehicles for food. 70 liters of biofuel consume a person's annual rations but can only drive a car forward for about 700 kilometers. The World Bank predicts that corn ethanol can save 2% of global oil consumption, but it will cause a 30% increase in food prices. On the other hand, food prices are distorted by the highly financialized capital system. Wall Street speculators have become the world's largest hoarders of food. In 2007, half of the total output value of corn, soybeans, and wheat in the United States was held by buyers of agricultural futures, and agricultural funds exceeded $150 billion. Capital speculation enlarges the imaginative space of grain prices, allowing futures prices to lead the trend of spot prices, and controlling the rise and fall of grain prices is as easy as pie. Grain prices are clearly embedded with unstable genes, and once anomalies accumulate to a certain extent, they will release risks. The release of this crisis reflects the complete ecosystem of economic civilization. The development of industrial economy, financial civilization, and other alienated agricultural food attributes undoubtedly turn to agricultural civilization for strong retaliation against industrial civilization and other civilizations. This kind of backbiting has made grain a strange attractor of instability in the world, even in the United States. There has also been a rice rush in China. In fact, food is becoming a more powerful political weapon than oil, rewriting world politics. Southeast Asia, used to be the world's granary, however, has weak disaster resistance and high fertility rates. Agriculture is mainly focused on labor-intensive crops, while ideas remain stuck in the agricultural era, and its vulnerability has been exposed in the rice crisis. The United States, on the other hand, is uniquely endowed with not only 13.15% of the world's arable land, forming a large-scale agriculture with large-scale planting and industrial management, but also the ability to turn the tables in the financial market and seize the commanding heights of genetically modified crops in agricultural technology. This gives the United States both capital and strength to wield food weapons. The corn ethanol strategy implies an international strategy. On the one hand, the United States consumes excess corn under agricultural self-sufficiency and monopolizes the pricing. The end of the investment banking era. The fifth wave of the subprime mortgage crisis has hit. Does the 8-day period from September 14 to September 21, 2008 mark investment banking the demise of the line? Lehman went bankrupt. Merrill Lynch sold, and Goldman Sachs and Morgan Stanley became regulated banks. This is part of the most disastrous transformation of investment banks since the Glass-Steagall legislation in 1933 created them. In the future, familiar names such as bulk bucket, the label of a large investment bank, and elite investment bank in the United States, will need to be redefined, and year-end rankings will be revamped, while clients and management will need to adapt to new basic rules. However, despite these changes, if investment banks survive the current crisis, they may also exist as familiar faces within the new organization, and the effectiveness of the investment banking industry will also be enhanced. In a sense, there won't be much change. The company we see as an investment bank has become a large gold mine run comprehensive group. After Morgan Stanley merged with consumer finance company Tianhui in 1997, it was no longer an independent investment bank. After Goldman Sachs went public in 1999, it went beyond the scope of investment banking by expanding trading and principal investment activities. By 2007, less than 15% of its earnings before taxes came from investment banking. In fact, pure investment banks have long ceased to exist. Incorporating some well-known old brands into banks and redefining some other brands will hardly affect customer service or market share. As for the performance of investment banks, whether these financial groups align their business with other businesses is just a symbolic issue. However, the market turmoil will bring opportunities for other institutions to enter the investment banking business field. In recent years, the financial services of human capital companies, hedge funds, and investment banks are showing a convergence trend. Goldman Sachs, which has a private equity and hedge fund business, is no more like an investment bank than the acquiring company Blackstone. Blackstone also has consulting experts and alternative investment funds. The ambiguity of these differences has led alternative investment companies into the
Fannie Mae and American International Group have also issued an $850 billion rescue plan with twists and turns, and strengthened supervision over the only two major investment banks by incorporating them into commercial banks. Does this mean the convergence of financial leverage? And Geller's judgment is absurd. From the perspective of the disposal method of non-performing assets after major evaporation, it is highly likely that the suit will change without changing the dressing, which is still the Wall Street style of the ultimate goal of $850 billion ESCUE fund operation is TOTTR Act and leverage more private capital and social resources to join in the reconstruction of market order and confidence. This means that the problems caused by the greed of many players on Wall Street will ultimately be solved together by these players. As for the possible changes, whether it is directly controlled by the government, serving as both a judge and an athlete, or investing in private capital, investing in non-performing assets, the government's return from the front to the back means that it is difficult for the government to stand on the opposite side of private capital or market players. Mixed operation and joint cooperation may become new features of the next stage of the financial market. From the trend of mixed operation between commercial banks and investment banks, it can be seen that commercial banks have not been spared this time, with the support of investment banks and hedge funds, improperly taking on the risk of excessive homebuyers and the excessive debt of investment banks themselves supported by credit products. The combination of the two may lead to further deterioration of the problem. Therefore, after the dust settles, after a period of repair, commercial banks are likely to repackage and sell their investment banking business, and the investment banking model will obviously not end. However, the transparency and leverage ratio of its derivative trading, including executives, will be strictly required and restricted. In fact, entering the financial civilization, the existence